We are going to practice correlation and diversification of portfolio in Excel. The last video clip, we have calculated the standard deviation with probability case with one the stock investment with different probability. And then we came up with the expected rate of return, and then we went through this process to come up with the standard deviation 13%. 9.5% expected rate of return has a standard deviation 13%, means the upside 13% and downside 13% has the variation, the uncertainty of this expected rate of return. So if this investment has lower the standard deviation, that means this expected rate of return 9.5% has higher uncertainty to get the rate to be achieved. But it's really hard to reduce the standard deviation once we have the historical rate of return like that way. So in order to avoid this standard deviation, we have to find the stocks that has lower standard deviation. But if we really want to invest in these stocks, there's no way to reduce this risk, right? That's why we can diversify our portfolio. Diversify means in a portfolio we put different types of stocks, different the types of classes of stocks or classes of assets, the all different type. That different type means different movement, different directions, a different rate of returns, so that we want to maintain the certain level of the expected rate of return, and then we can reduce the standard deviation of that portfolio. Okay, let's jump into this exercise right away. When you calculate expected rate of return of stock A and B, we have two combinations of stock A and B, and then this portfolio is stock A and C, right? And then let's calculate expected rate of return with just average function. And then, okay, we got the 4% is expected rate of return from the past 5 years information of stock A. And the stock B, also, I just want to use this function. So 12.4% is the stock B expected rate of return. Okay, anyway, you can just the roughly the portfolio A and B expected rate of return would be in the middle, around 8%, right? Okay, let's compare this stock A and C's portfolio. Here we go. So again, the same way, average of this historical rate of return. Also, the stock C also like this. Even though the stock B and stock C has different historical rate of return, the expected rate of return is average, which is the same, right? And then standard deviation of the stock A for 5 years. So as we practiced earlier, let's assume that historical data is the total population. So standard deviation P is the function of this standard deviation calculation. So 19.8% is standard deviation. Expected rate of return 4%, but standard deviation 90.8% is so high, right? But I don't know why do we choose a stock A? Maybe there are some reasons. The stock A provide huge amount of the cash dividend, or you are the stock A's the large shareholders, or you expect some future growth of this stock. I don't know, but anyway, this is not the point of this the practice. So standard deviation of stock B. So I just use the function copy and paste. 12.2%. Okay, so 12.4% expected rate of return with the standard deviation 12.2% is still very high, right? What about this? The stock A also, I want to use that function because Excel, remember this function, okay? The standard deviation population. standard deviation population of stock A and C. So as you can see, it's very similar, right? The 4% 12.4, 4% 12.4, and a little bit lower, but still very high standard deviation around 20%, around 20%. So let's make the portfolio in which stock A and B invested. We assume two stocks in the portfolio have the same weight of investment. That means 50% stock A, 50% is stock B. So the portfolio stock A and B in year one, right? We just use average of these two. Then also 13%. Oh, sorry. So this is average of these two, right? So we use this average every year, and then expected rate of return of this portfolio is 8.2% as we expected, because we put 50% on the stock A and 50% in stock B. So expected rate of return of this portfolio A and B is around in the middle, right? Exactly middle. And then standard deviation is this. The standard deviation, the population, is the historical, the portfolio A and B combination, right? So 19.5% standard deviation. Do you see the 19.5% standard deviation still around 20%? The reason why we want to construct the portfolio A and B is for diversification, right? But there's no diversification effect. The diversification effect should give huge a drop in the standard deviation. We want to reduce the risk. We want to reduce instability. We want to reduce the deviation, uncertainty. But there is no effect on the portfolio. Okay, I would rather the investors only stock B 100%, 12%, because the standard deviation stock A and B and portfolio A and B are almost the same. So why not? We just invest in stock B full amount with expected rate of return 12.4%. There's no the diversification effect on the portfolio A and B. What about the stock A and C portfolio? In the same way, we use average this stock A and B, 50% stock A, 50% stock C in the year one, so 5%. And then I want to use that function, same. And then the expected rate of return is going to be just average of this 5 years portfolio A and C is 8.2. Okay, let's take a look at this and this. 8.2% expected rate of return portfolio A and B is the same as expected rate of return on portfolio A and C. Anyway, 8.2% is the satisfaction of this portfolio management. So, what is the standard deviation? Let's calculate standard deviation. Standard deviation, this portfolio A and C for 5 years. Let's take a look at this standard deviation. Let's compare this and this. Okay, let's increase the font size. So we could reduce the significant the amount of standard deviation with portfolio A and C. Why? Why is it is possible? Why is it possible? Because 4.7% came from the correlation A and C is negative. But the standard deviation 19.5% doesn't have any diversification because the correlation A and B is almost the same, the positive. That means when stock A increase 10%, the stock B increase. When stock A decrease, stock B decrease. Stock A increase, stock B decrease. The same, exactly same directions. exactly same direction, even though they increase this different level or decrease the different level, right? But here you go. The stock A and C has been moving the totally opposite direction. When stock A increase, the stock C decrease, stock A decrease, and stock C increase, right? They moving the totally opposite directions. So they compromise each other, right? When stock A was good, but stock C was not good. But that's okay. They still make a positive the rate of return on the portfolio. But when you compare this portfolio, the portfolio A and B increase, decrease, decrease, increase, increase, decrease. There's significant drop, the up and down, right? It's not much stable. But the portfolio A and C are moving a very stable way. Every year they are making the positive the rate of return in the portfolio because they compromise like that way, right? So that we were able to come up with the standard deviation very low level. Okay, if we invest the stock A and B, oh, there are huge up and down 19.5% when we expect rate of return 8.2%. But when we invest the portfolio A and C, we expected 8.2% with the standard deviation up and down 4.7%. Even though the standard deviation was negative 4.7%, we still make positive the expected rate of return around 3.5%, whatever, right? So we want to know the causation of this effect, right? Which is correlation. Where does the effect come from? So correlation means the relationship between stock A and C, their movement, the directions. They are moving in the same way or opposite way. So correlation stock A, comma, and stock B. Then 0.81 means 81%. 100% means they are moving on the same direction with the same level, right? But they are moving, in this case, 81% almost the same way. So there's no diversification effect in this portfolio with A and B, right? What about the correlation A and C? Correlation A and C, you will see the totally opposite result, negative 0.88. So the maximum is minus 1. They are moving totally opposite if they have the correlation of negative 1. One stock moving that way, the other stock moving the other way around, right? The total opposite, like this stock A and C. If the correlation A and C is negative 1, that means they are moving totally opposite way with the same level, right? But yeah, in this case, they are not. But anyway, if the stock has the correlation, the negative amount as bigger the negative as possible, then the portfolio, the standard deviation, can be reduced like that way. Okay, that is one of the way to reduce, to control the risk of portfolio for the portfolio. So portfolio measures the standard deviation and the correlation of the portfolio. They are creating the portfolio. Okay. So next time we are going to discuss about the beta, another measurement of riskiness. Okay. See you next video clip.